Hey, what's up guys? It's Clint Coons here, and in this video we're going to talk about the 5 mistakes that I see real estate investors make when it comes to their asset protection. Okay, let's get started. Okay, so what is the first mistake that I commonly see whenever I sit down with a new investor client that has already had some structuring going on? It's that they choose the wrong entity. You see, when it comes to real estate investing, a lot of times people either have an existing entity that they're trying to then turn from a business into investing in real estate, or they just set it up wrong from this get-go because they didn't understand how they should be setting it up. Now, what do I mean by the wrong entity? It really comes down to taxation. So when we're talking about limited liability companies, okay, which most people are going to use, they'll set up an LLC for their rental real estate. You've seen my other videos on this throughout my channel talking about LLCs. The problem is, how is that entity taxed? You see, when you're using rental real estate, if it's an investment property, you want that income and that depreciation to flow out so you can take it on your 1040. You also want to be able to have flexibility with your structure. So if things need to change, such as you want to refi the property, you can take the property out and it won't create any adverse tax consequences. So the mistake that I see a lot of investors have made over the years is that when they create a structure, many times they will elect S corporation taxation for that LLC, or possibly they already have a limited liability company that's treated as an S corp. Maybe they have an existing corporation right here, and this is an S corporation, or even worse yet, a C corporation, and then they buy a house in the name of that company. Because for a lot of us, it's like, why set up a new one if I've already paid to set up this one company? The issue is that when you use an S or a C corp, it'd be an LLC taxes an S or a C corp, or just a traditional corporation, is that if you ever need to move the asset out of that company, it's a taxable event. And so here's what happens. Oftentimes we'll meet people that have set up an S corporation, they have multiple properties inside of it, and then they want to adopt a strategy where we're going to create multiple limited liability companies like this. We want to shut this one down, transfer these properties out, and put them in separate LLCs so we're minimizing our overall risk exposure. The issue is that we can't do this. We can't pull them out of that company because it's treated as an S corp and they're going to get hit with taxes if we did that. So we're forced to come up with a hybrid structure for them, typically, which means you create LLCs up here and you drop them down into that one structure. I should cut a video on that to tell people how to fix their S corp screw-ups if they've already started investing in real estate. That's a video for a different day. Okay, so this brings me then to my second issue I see with people who set up structures for their real estate investing. And that is, when they create the structure, they don't think about anonymity. So they're creating that limited liability company here that they're going to set up. Say they want to invest in Ohio, so you create an Ohio limited liability company, and you never consider the ramifications that if you set this up, you're going to be listed on the LLC. You're listed as the organizer on that company because you submitted the filings. You could be listed as a member or manager if the state collects that information. And then once the deal's done and you have your property inside of there and you later decide, hey, I watched this guy on YouTube named Clint and he's talking about the benefits of anonymity and I really want that. And so ideally what we would like to do is take you out, right? Put in a Wyoming LLC down here and make this LLC member managed by the Wyoming LLC, so your name doesn't appear on the Secretary of State's website. It's going to be the Wyoming LLC. The problem is you're in the chain of title, meaning that you're in that chain of paperwork that was submitted initially. And if we attempt to do this little strategy right here, somebody could figure it out. All they have to do is research this entity and see that 3 years ago, you created it. Now, granted, today you're no longer listed on anything associated with that LLC because it has your new Wyoming holding company there, but it's still traceable back to you. So if you want anonymity, you have to start with that strategy to begin with. So you first start with this entity here, then when you create this entity up here, you don't do the filing. You hire someone else to do it. Like my company Anderson, we will do the filing, so your name doesn't ever appear on anything that's submitted to the state. Okay, great. So that's number 2, unable to obtain anonymity. Now the third mistake that I see people make with their structuring is that they've created their LLC right here. And don't worry about the colors today. I'm not doing Wyoming and blue and stuff. I'm just spitballing here with a pen. So we've got this Wyoming or we've got an LLC set up, and now we have this property right here. We had to take title in our own name because we're using Freddie Fannie to buy it. And now we want to deed it into this limited liability company. So we prepare what is termed a quit claim deed to transfer this property into the LLC. The issue with using a quit claim deed is that when you transfer property via quit claim deed, if I'm doing the research on this title transfer, and let's say that your name doesn't appear here, we don't know who owns this LLC because you didn't screw up in number 2, you used anonymity to begin with. The thing is that if I see a quit claim deed going from an individual's name to a business entity, I know that person is still the owner of that business entity, even though they're not listed there. Why? Because no person would ever accept a quit claim deed if they're buying a piece of property. Think about it. When you bought your house or your rental property, did you take a quit claim deed? No. Why not? Because a quit claim deed is like an as is. When you buy property as is, you take whatever you get. When you accept a quit claim deed, you're getting whatever this person holds. And if that person doesn't own anything or it's fully encumbered, you take all those encumbrances that come with that property. That's why people don't accept quit claim deeds from sellers. So I know now that this was not a bona fide transaction, that this isn't some third party here, because they would never take a quit claim deed from this individual. So you just clued me in. The only time this is going to take place is when you own the entity, because you trust yourself. You know what's going on with the property. All right. That brings me to number 4 in the mistakes that we see many times. When people create limited liability companies and they file the entity with the Secretary of State, they think, oh, I've got an LLC, and they stop right there. That is a problem. What you need to now have is an operating agreement. All right, this needs to get set up, and the operating agreement spells out what happens with your limited liability company, who the members are, who the managers are, how distributions are going to be made. More importantly, the importance of an operating agreement is so that if you're ever dealing with a title company or a lender and they ask to see a copy of it, you want to make sure that that operating agreement carries weight. So what do I mean by that? Let's say I'm going to borrow some money, and I'm trying to work with the LLC to get this loan done. It's a non-qualifying mortgage, and they ask to see a copy of my LLC, and I send over my articles of organization. No operating agreement. Well, most lenders will expect that anybody who set up an LLC has drafted an operating agreement that spells out how the company is to be run, not just the filing with the state. So then what I've seen people do before is they jump on the internet, they print out a 6-page operating agreement they found for free. Maybe it's on an inkjet printer and half your ink is running out, and so it went from black to gray as it goes down. They throw it on their desk where they just had a cup of coffee and there's a coffee stain on it, and then they sign it and they turn it in to the lender or to the title company, and they say, hey, take me seriously. Now come on, what do you think they're going to do? They're going to realize that you are not taking this business seriously, that you're just doing it as you're going along, trying to put things together on a shoestring. And so that's going to give them pause. When you set up an LLC, what's important and what I say is critical is that you draft an operating agreement, that represents what the company's business is, right? So the operating agreement, if it's rental real estate, it's going to talk about rental real estate, or if it's flipping, it's going to have provisions for flipping inside of there. But more importantly, the operating agreement looks like it was done professionally. That's going to help you do more. So it's critical that you draft an operating agreement. Now, the last mistake that I see over and over again with limited liability company or asset protection for real estate investors is that once this structure is in place and it's set up, many times we're moving from a place where you own the property, right? Then we're deeding it into the LLC, not using a quit claim deed, but using a warranty deed. I didn't tell you that. You use a warranty deed. Now it's in the limited liability company, but you still have your tenants, right, that are renting the property. And what do? You keep collecting the rents directly from your tenants, and you're not running the money through the LLC. That is a huge mistake, because if anything goes wrong, the perception is that you own the property. Now, somebody could say, well, you could look that up on title, Clint. You could see that the LLC owns the property. So even though I was collecting the rents, I'm not the owner of the property. But the problem is that you expect the LLC to protect you. Now, if you're running the money from the tenant directly to you and then it goes into your personal checking account, you've got a problem. You're ignoring the separateness of that limited liability company. And by ignoring the separateness of the LLC, the courts will do it as well. So if you make this mistake and you're running money directly yourself, then you definitely need to run it back to the LLC and then take out a distribution. This is how the money should go. Take out a distribution out of your LLC. What I recommend people do is that after they put their property into the LLC, contact your tenants. Tell them, hey, there's a new owner on this property. Going forwards, please send all payments to XYZ LLC. So you got your bank account here, tenants paying the LLC, and then you're taking out your distribution. So those are the top 5 mistakes I see real estate investors typically make when they're setting up their asset protection. And going forwards, I know you will no longer have that problem. Hey guys, if you like this video, smash on that like button. And if you're not yet a subscriber, well, you know what to do with that subscriber button as well. Thanks for watching. Take care.